Hi. Let's learn about the accounting rate of return, ARR. The accounting rate of return reflects the percentage rate of return expected on an investment or asset compared to the initial investment's cost. The accounting rate of return is a useful capital budgeting metric for calculating an investment's profitability quickly. It factors in any possible annual expenses, including depreciation, associated with the project. The formula for the accounting rate of return is ARR equals average annual profit divided by initial investment. For example, a business with an initial investment of $250,000 and 5 years of forecasted revenue could calculate the ARR to determine the expected rate of return. The ARR is the annual percentage return from an investment based on its initial outlay of cash. On the other hand, the required rate of return is the minimum return an investor would accept for an investment or project that compensates them for a given level of risk. ARR is a simple calculation that allows managers to compare ARR to the minimum required return and make informed decisions. It also comes in handy when comparing the return of a project quickly. Despite its advantages, ARR does not consider the time value of money or the impact of cash flow timing, and it does not account for the increased risk of long-term projects. Depreciation reduces the accounting rate of return as it is a direct cost that reduces the asset's value or company's profit. The decision rule is to accept the project with the highest accounting rate of return as long as the return is at least equal to the cost of capital when presented with multiple projects to invest in. The main difference between ARR and IRR is that IRR is a discounted cash flow formula while ARR is a non-discounted cash flow formula. The accounting rate of return is a simple formula that allows investors and managers to determine the profitability of an asset or project. However, it does not take into consideration the cash flows of an investment or project, the overall timeline of return, and other costs that help determine the true value of an investment or project. Here are 5 key takeaways. 1. The accounting rate of return, ARR, formula is helpful in determining the annual percentage rate of return of a project. 2. ARR is calculated as average annual profit divided by initial investment. 3. ARR is commonly used when considering multiple projects, as it provides the expected rate of return from each project. 4. One of the limitations of ARR is that it does not differentiate between investments that yield different cash flows over the lifetime of the project. 5. ARR is different than the required rate of return, RRR, which is the minimum return an investor would accept for an investment or project that compensates them for a given level of risk. Hope this would help. Thanks for watching.